Thank you very much for inviting me. It's a great pleasure. I wish I was there, but that's the way things are. Okay, so this is a paper with Mickey Levy. I'm going to do the presentation, and Mickey is going to jump in on the Q&A afterwards. So let's go to the next slide, please. Yeah. Okay. So there are a lot of slides. So you have to listen. Okay. The current COVID-19 pandemic has led governments to follow expansionary fiscal policy, which raises their fiscal deficits and debt to GDP ratios to levels that we haven't seen since World War II. Central banks are also following very expansionary policies. They've reduced their policy rates close to zero, and they've followed expansive quantitative easing and forward guidance policies. They've also engaged in extensive lender of last resort. They've extended it to non-financial activities. They follow extensive credit policies, and when you have low interest rates, by reducing debt service costs, that encourages fiscal expansion. Next slide, please. Yeah. Okay. So the policy response to the pandemic combines elements of the responses to World War II and other World War I, II, the Great Depression, and the global financial crisis. And these episodes in differing degrees led to rising price levels and inflation. So what we do in this paper is we survey the historical record for over 2 centuries. And what we find is that fiscal deficits, which are financed by monetary expansion, tend to be inflationary. Next slide, please. And this holds for both wartime episodes, where fiscal dominance prevails and the central bank acts as a money printing press, but also there are some episodes, inflationary episodes of fiscal dominance in peacetime. And I'm focusing primarily on the advanced countries. We know the story about them, the emerging countries. Some argue that the inflation in some of these episodes, some people have said, reflect bond finance fiscal expansion, which is unbacked by future taxes. And this is what the fiscal theory of the price level argues. The present response to the pandemic echoes some of the patterns of the past and may lead to a run-up in inflation in the US and possibly other advanced countries. Next slide, please. Okay, so I'm just going to briefly mention some theoretical perspectives on this and then move into the history. So traditionally, there's sort of in the 20th century, there are 2 theories that have dominated the approaches of economics to fiscal deficits and inflation. The early Keynesian models came out after World War II. They argued that any increase in aggregate demand is going to lead to an increase in nominal income, and then how much goes into prices and how much goes into output depends on the aggregate supply curve. So the earliest ones talked about an L-shaped aggregate supply curve. Once you get to full employment, then any change in aggregate demand, and here it's a change in the fiscal deficit, is going to lead to inflation. They also assumed that monetary policy was impotent and that we're in a liquidity trap, so that monetary policy wasn't causing inflation. Then you throw in the Phillips curve and you can get both output and prices rising. Next slide, please. Okay. Simple quantity theory said that changes in the quantity of money lead to changes in nominal income. Initially, it goes into real output and then into prices. And to get inflation, you need sustained money growth. And once inflation is anticipated, velocity rises, which amplifies the effect of changes in money on inflation. In the early monetary quantity theory approach work, fiscal policy on less money finance was said to have no effect on anything, on either output or prices. Okay, next slide, please. Okay, so there are 2 modern approaches that follow from this. Sargent and Wallace, in their Some Unpleasant Monetarist Arithmetic in 1980, extended the sort of quantity theory approach to a dynamic setting with rational expectations and perfect foresight. And they argued that bond finance fiscal deficits will ultimately be accommodated by inflationary increases in high-powered money to satisfy the government's long-run consolidated balance sheet. And the second is the fiscal theory of the price level associated with Chris Sims and John Cochrane and Eric Leeper. And here the point they make is that if you have bond finance fiscal deficits, if they're not fully backed by future taxes, that leads to fiscal dominance. And they're operating also in a world of, a dynamic world. And in this framework, if you have an increase in debt, that leads to a wealth effect, which raises expenditure and prices, and that restores fiscal equilibrium. Okay, next slide, please. Okay, so what I'm going to do, okay, I have a lot to say on the wars, but I don't have enough time. I realize that. So what we're going to do is I'm going to shift to the peacetime episodes. Before I do that, so what we did was we looked at advanced countries. We looked at a number of wars from the 18th century to the 20th century, and we looked at at the relationship between fiscal deficits, issues of money and inflation, and we looked at Sweden in the 7 Years' War. We looked at the American Revolution and the issue of the Continentals, the French Revolution, the assignats. We looked at the Napoleonic Wars in Britain, and what the Bank of England did once the suspension occurred in 1797. We looked at the U.S. Civil War. We compared the North with the South, and then we looked at World War I and World War II in the U.S., and we also talked about the U.K. So the key features, the key takeaway from this war stuff is that the use of fiat money as an inflation tax becomes more dominant over time as wars lengthen and become more expensive. And secondly, you get this phenomenon of the central bank, when you have one, being dominated by the Treasury. So it becomes, in a sense, endogenous. It becomes a printing press. And then the third key point that comes out of that survey is what really matters is what happens after the war. How do you exit from the war? And there was a real difference between what happened up till the second decade of the 20th century and since. So in the 18th and 19th century and early 20th century, you went back to the gold standard, and you had deflation, and you had fiscal surpluses. After World War II, we had some surpluses, but we ended up having inflation. Okay, so that's all I'm going to say. And what I'd like to do is, if you could move ahead, okay, in my slides it's slide 20, but why don't you move ahead until we get to the peacetime episode. So just keep going forward, okay. Okay, wait, move back. Okay, go back again. Back again, please. Back. Okay, stop there. Okay, next one. Slide. Okay, perfect. Okay, so I'm going to talk about a few episodes, peacetime episodes of fiscal expansion and high inflation in the 20th century, and then we'll compare it to the present. So one story is of France in the 1920s. Okay, so the losers in World War I, the Central Powers, they had fiscal disasters resolved by hyperinflations. Everybody knows about that. France was a winner of the war, but its fiscal affairs were not in good shape. So they had a fiscal stalemate, and they had 7 years of high inflation, and this was, in a sense, a good example of fiscal dominance. If we were to compare the UK and France, you'd see that Britain emerged from World War I with more than a double price level, and so did France. France was a little higher. They both had high ratios of debt to GDP. They both had large fiscal deficits, and they both had devalued exchange rates. I'm going to show those slides in a second. So Britain stabilized inflation and went back to gold at the original parity in 1925. France stabilized later and resumed parity on the gold standard of the 80% devaluation. France had a fiscal impasse between the left and the right about how to finance recovery. Next slide, please. Okay. Okay, so these are the pictures. It's price level. See how France goes up more than the others. Okay, next slide, please. Okay, this shows the debt ratio was higher, but not that much higher, but it's higher than the UK. Next slide, please. Okay. Budget deficits again. You see that the French are running a bigger deficit, but not that much, not that greater. And figure 7, next slide. That's the exchange rate. You see that Britain goes back, they go up. Okay. Okay, next slide, please. Okay. So you had this political tug of war. It lasted for 7 years. There are several changes of government. And instead of raising taxes and cutting government expenditure, the government issued short-term T-bills. And of course, the fight was over how to pay for the war and who was going to pay. And the French believed that the Germans should pay and the reparations should do it. The Germans didn't come through. So this is what happened when they didn't have the reparations. So instead of raising taxes and cutting spending, the government issued short-term T-bills, which were passively absorbed by the Banque de France. That led to inflation and a depreciating exchange rate. And the only way they got fiscal balance was achieved by Poincaré in 1926, worked out a deal where you raise taxes, cut spending, they borrowed dollars from JP Morgan, and they devalued the franc by 80% and went back to the gold standard. So this example has some resonance for the fiscal theory because it was a case of fiscal dominance, a passive central bank, and unbacked fiscal expansion. Okay, next episode, next slide, please. Okay, so another episode that's of interest, peacetime, is the recovery from the Great Contraction in the US from 1933 to 1936. So Friedman and Schwartz, they attribute, in the monetary history of the United States, they attribute the recovery from the Great Contraction, which begins in March 1933, to the banking holiday, and then Roosevelt leaving the gold standard, and then devaluing the dollar by, sorry, it should be 40%. This increased the monetary gold stock and money supply, leading to rising prices. Now, recently, a paper by Eric Leeper and co-authors argues that if you follow the fiscal theory of the price level, you can explain the inflation in the 30s by Roosevelt's issue of unbacked fiscal expenditures, okay, to finance these emergency measures, the WPA, CCC, etc. At the same time, the Fed is passive. So what that does is it increases nominal gross debt, leads to an increase in consumption and rising prices. Of course, there's an issue here because there's in a sense an equivalence between the two, the monetarist approach and this one. So this is something that's going to end up, this debate's going to go on. Okay, next slide, please. Okay, so now we're going to talk about the great inflation in the U.S. and then in the UK. So the Fed, lost its independence from the 30s into 1951, and they became dependent on the Treasury to finance the war, and then afterwards there was this long period of a low interest rate peg. And so the Fed got the independence back in February 1951 after a big struggle that Alan Meltzer well describes. And at the same time, and William McChesney Martin becomes the chairman, and he is he follows fairly orthodox monetary policies geared towards price stability and preserving the gold dollar peg of the Bretton Woods system. At the same time, you've got this conservative fiscal policies of the Eisenhower administration. So succeeding Kennedy and Johnson administrations attached higher priority to U.S. growth, increased growth, and reducing unemployment using Keynesian aggregate demand management policies. A tax cut in 1964, the Kennedy tax cut, increased the fiscal deficit, and at the same time, the Fed becomes accommodating monetary policy by its even keel operations. What this means is the Fed wants to keep bond prices high and rates low, while the Treasury is funding the debt. Okay, as the Vietnam War picks up and other big expenditures increase, the Treasury is always in the market, so the Fed does not tighten when it really wants to. So you can see figures 8 and 9. Next slide, please. Yeah, so that's the budget balance, and shows you that it's getting bigger and bigger, and this goes all the way through to 1980. Next slide, please. Okay, this shows M2 growth, the rates of change. Again, you see that it picks up in the 60s, drops a bit, then comes back in the 70s. Next slide, please. Okay, so what happens is inflation increases after 1962 slowly, then increases more after 65 with the Vietnam War and the Great Society. And then Alan Meltzer describes how the Fed adopted Keynesian doctrine and the Phillips curve and kept attaching greater weight to unemployment and inflation. So you get a ratcheting up in inflation, and you got loose monetary policy, which is behind this. So see figure 10. Next slide, please. Okay. Well, it's coming up. And then what happens, as in 1966, what happens is that the Fed tightens under political pressure, unemployment rises, then there's more pressure. Sorry, it tightens, okay, to deal with the inflation, unemployment goes up, okay, and then they face political pressure and they loosen again. And one example, and a good example of pressure was Lyndon Johnson's verbal attack on Chesapeake McMartin in December 1965 after the Fed raised the discount rate and ignored previous pleas by the administration not to do so. And this, in a sense, it is said, okay, really kind of made Martin pull back a lot and become much more compliant. And what this did was it convinced the public that the Fed did not attach high priority to inflation, which becomes more persistent as inflationary expectations become embedded in the public conscience. Next slide, please. Okay, then that's showing the bounce up in the inflation rates. Next slide, please. Okay, so then Nixon becomes president, and he's campaigning on an agenda to roll back the expansionary policies that the Democratic administrations had followed. He makes Arthur Burns his chairman in February 1970, and Burns was viewed as an advocate of sound money, and he, of course, was Milton Friedman's teacher. But what happened was that in 68 and 69, tight monetary policies were followed, which led to a recession, but inflation was not quite vanquished. What happens is then, under pressure from Nixon, because of the recession, Burns begins expanding the money supply again in 1971. Next slide, please. Okay. And he accedes to a promise that he'd made to Nixon when he's installed as Fed chairman that there'd be no recession on his watch. Nixon said, quote, "You see to it, no recession." Burns said yes. And then Burns he changes his whole views on what causes inflation, okay, that it wasn't monetary policy, but it's cost push by big labor unions and large firms. He begins advocating wage price controls, which leads to serious distortions. And of course, a key casualty of all this is Nixon's closing of the Bretton Woods gold window in August 1971. Next slide, please. Okay. So the rest of the story, the 70s, is pretty familiar. You've got the Arab oil embargo in 1973. The Fed accommodates it when the controls which have been imposed by Nixon are lifted in 1974. Inflation shoots up, and then you've got this ongoing dance of high and rising inflation, and then an attempt to cut back, and then political pressure and the Fed caving in. At the same time, fiscal deficits are going up. The Carter administration came in 1976. They tried to corral inflation with various ways. It didn't work. There was a dollar crisis in 1978. He appoints G. William Miller as Fed chair in 1978. and he's very unsuccessful. There's a second oil price shock, which is accommodated. Next slide, please. Okay, and then the crisis is resolved by the appointment of Paul Volcker as Fed chair in October 1979, who was given the mandate to follow aggressive monetary tightening, and he was successful, but at the expense of a serious recession. So, and that restored the credibility of the Fed and led to the Great Moderation. Okay, I'm going to talk for a few minutes also about the UK, the Great Inflation. Next slide, please. Okay. Yeah. So this is based on a paper I'm doing with Oliver Bush and Ryland Thomas at the Bank of England. So we argue that we want to explain why the UK did worse in the 60s and 70s than the G10 average. So we see it as a story of fiscal dominance, under which the fiscal deficit, public sector borrowing requirement, is accommodated by the Bank of England, which at the time wasn't independent. And that in the 60s, during the Bretton Woods period, the UK followed a go-stop policy. And a key fundamental of that period was slow growth in real growth, and slow productivity goes lower than its trading partners. So to spur the economy, the Treasury generally followed expansionary fiscal policies. And so you had these persistent and rising fiscal deficits, which were mostly accommodated by expansionary monetary policy. Okay, next slide, please. Okay, so this is this picture shows money growth and inflation. Okay, it's sterling M3 and sort of picks up the pattern we're going to talk about. Next slide, please. Okay, and this one shows you the public sector borrowing requirement and also the current account, which I will talk about in a second. So next slide, please. Okay, next, yeah. So the stop-grow policy is justified by the belief in Keynesian aggregate demand management, a belief that expansionary demand policy would not only reduce the output gap, but would also raise the long-term growth rate. This was the view of Nicholas Kaldor and the National Institute of Economic and Social Research. And then there was a third argument, was to improve the living standards of labor. Okay, next slide. Okay, so what happens is that during the Bretton Woods period, the successive governments of both countries pursue the go policies, and then you have an expansion for 2 or 3 years, and then you hit the balance of payments constraint, and you get a speculative attack on the Bank of England's international reserves. There's 4 of them here. This leads to rescues by the IMF, G10, Fed, etc. Conditionality, which is imposed, requires a stop policy. Next slide. Okay. And once the reserves are restored, then the pressure is on the government to expand, and you go into the go phase. And then what happens in the go phase is prices rise and inflation becomes a growing problem. And as inflation goes up, so do inflationary expectations. So in each successive stop, the underlying inflation rate would be reduced, but not entirely. So you get this ratchet effect. And as in the States, you have wage price controls because inflation is seen as a cost push story. Next slide, please. Okay, so once the Bretton Woods system collapsed, there's no stop. It's just a go phase, and you get a hyper go phase because the balance of payments constraints greatly weaken. And here you get the famous barber boom, where you got fiscal policy accommodated by expansionary monetary policy, and that leads to a big upturn in money growth and inflation. So you can see this in figure 11. Okay. Next slide. Yeah, okay. So go back. Okay. Previously, okay, fine. So then you got the oil price shocks. They're accommodated like in the US. And by 1975, you got inflation running at 25%. This leads to a sterling crisis. It's not like a fixed exchange rate, but the exchange rate just plunges. With high inflation, a plunging exchange. IMF rescue in 1976 with a prescription for tight fiscal and monetary policy. Next slide. Okay, next slide. Okay, so that we argue was it's this external intervention is the catalyst that led the Bank of England officials to pay greater attention to monetary aggregates and to the monetarist views. And then the Great Inflation culminates with this regime change when Thatcher comes to power and applies the monetarist medicine, just like in the US. Okay, so I stop there, and I'm going to take a couple of minutes, 5 minutes. I want to get to the present. Next slide, please. Okay, next slide. Okay, so the global financial crisis triggered by a housing boom in the US. Okay, we all know the story. Next slide, please. What happens is you get aggressive fiscal and monetary policies. The Congress enacts the Emergency Economic Stabilization Act in 2008. Okay, that authorizes financing of the Treasuries, the TARP program that gives capital infusions into the largest banks through the purchase of toxic assets. The policy rate is falling. Okay, by the end of 2008, the Treasury, the Fed hits the zero lower bound, begins its quantitative easing policies. Another government fiscal package is the Economic Recovery and Jobs Act, which is a fiscal stimulus of $780 billion in deficit spending. So the combined government spending and emergency loans approximated 10.3% of GDP, was a lot less than the spending in the wars, but was still the largest peacetime spending since the Great Depression. Next slide, please. Okay, so the massive fiscal and monetary expansions lead to fears of future inflation and fiscal dominance, and a fear that ever-rising government debt's going to dominate monetary policy, and that's going to force the Fed to maintain an easy policy to constrain the debt service costs. But it didn't happen. Inflation in the following decade was modest and never reached the Fed's 2% inflation target. Okay, next slide.
Could you come to the end, please?
Yeah, I'm coming. Let me finish this. Okay. So the question is, what happened? And one reason is that the Fed's QE policies were greatly expanded its balance sheet, but it ended up as excess reserves held by the banks, and the banks didn't lend it out, in part because they're paying interest on excess reserves. Okay, and there were other factors, and so that we didn't get inflation. Next slide, please. Okay, the next slide. Okay, next slide. Okay, so now next slide. Okay, there. The pandemic, again, we have a serious recession. Okay, and partly because the government shut the economy down. The government responds with unprecedented monetary and fiscal stimulus. Okay, the fiscal stimulus is 13% of GDP. It's a bit like World War II. The expenditures are debt financed. The Fed lowers its policy rate to zero. Okay, and now we argue that compared to the GFC, it's a greater risk of higher inflation, because this time both the monetary base and M2 grew by 47% and 23% respectively. So go next slide. Okay, next slide. Okay, so this shows you pictures of the money. And okay, next slide. Okay. Okay, and also we talk about how the current Fed policy, the average inflation targeting policy, tends to favor higher inflation and inflationary expectations, because it doesn't really tell the Fed. Fed doesn't tell us what they're going to do if they reach higher inflation. Okay, and also they've increased the mandate for trying to hit low unemployment. Next slide, please. Okay. So the size and current projected government debt suggests there's several risks for fiscal dominance. The government's net debt service costs are sensitive to interest rates. That's going to increase as debt rises. That could lead to future pressure on the Fed not to raise rates in the future. The Fed remits income earned on its large balance sheet to the Treasury. Policies to reduce in the future could be reduced for this reason. And pressures are likely to continue in the future to increase government social spending, infrastructure, etc. So it's going to be difficult to reduce the primary deficit by cutting entitlements. And this is going to be another reason to keep net debt service costs low.